There has been a lot of changes that have happened last year, 2022, but also been a lot of opinions about what to expect for 2023. Now, what we want to do is set aside those opinions and work to take a look at the data, what it is saying, and the best places probability-wise to be invested for first quarter 2023. I'm Nathan Krampe, and I create these videos because I want to be helping you to set yourself up correctly so that you can be investing for the long term, but also be risk managing your hard-earned wealth. The more you can do that, the more you can start to say that you can have a great financial plan and wealth management strategy in place, knowing you have the risk management taken care of on the daily basis. So with that, let's take a look at and dive into 2023 and specifically the data behind what's to come. Okay, as I am pulling up my screen here, I have picked a couple slides that I want to be going through today because these slides have been a culmination basically of about 100 to 150 different slides that we've pulled together and really boiled down to the so what's and how you can be working with things here. So that is a very, very good realistic way to take a look at things here. We can be taking and extrapolating from large data sets and putting them down into some very specific types of graphs and things that we can actually be using now. So let's pull up this first chart here. This is where we're projected to go for our GDP for not only the next couple of quarters, but where we have been as well. And what you're starting to see here is that we have really been in an area that we had a lot of growth coming out of COVID, and we've been starting to slow over the course of the last number of quarters. Now, last year, 2022, we had not exactly that great of a second quarter. We really didn't have that great of a third quarter because our GDP was starting to slow, even go negative for the quarter on a quarter-over-quarter basis. Well, we had a kind of a comeback and a resurgence of our economy in fourth quarter, and that's a lot of the data that we had been seeing coming out. But things are starting to shift a lot more now, and when you take a look at where we're at today, we're actually starting to go again negative with our GDP. And this has been something that has been predicted and what we've been thinking of, and nothing has shown this more apparently that our GDP is starting to contract more than the manufacturing index, the ISM index that has come out last Friday, the 6th. Now, what that showed is that we are what's called in contraction territory. So it's actually shrinking, and that is a very, very bad sign for what's to come, because when we take a look at the manufacturing index, that really talks about the fact that it precedes a recession. So we know that data is getting worse, not better, and this graph right here is actually showing it as well, that the next number of quarters is not going to be great for the stock market in general, well, especially I should say the economy in general, and we'll see about the stock market, but the economy is starting to slow down at a faster pace. And when we couple that with what Jay Powell is doing by raising interest rates, we could start to see this, the manufacturing index, and many other signals start to kind of show that recessionary type of environment more. So this is a big piece of the puzzle here, because when we know what to expect with the economy, we know what the Federal Reserve is likely going to be doing, and we also know kind of going into, in this case, a recession, what to expect with not only the stock market, the bond market, but many other asset classes that you could be investing into. And I'm going to touch on those here in just a minute. Well, let's hit on inflation as well, because when we talk about where we're going with the stock market, the bond market, we need to know where we're going with inflation. And we have seen this peaking of inflation. Now, this peak inflation really started to happen about 6 months ago, June of last year, 2020, and that has been something that now is starting to slowly trickle down. Well, we're starting to see a lot of people start to jump aboard this type of thought process that inflation is slowing in general. And again, this right here is not a thought process. This is just based upon the math. So this is not what we're trying to think and open about. This is actually something that is just mathematically, if the data is coming in, where it's coming, basically what it's saying right now is that we will be in this environment of a slowing of the pace of growth of inflation. So that's actually a good thing for you and I, because that means that prices aren't going to be going up nearly as fast, and other areas like natural gas, oil have come down in price significantly since 6 months ago, and that's going to be a great news for, say, the pump and for the things that we need. Because if we need to heat our homes, if we need the electricity there as well, if we need to drive places, all of those cost money. And if that's costing less today than it did 6 months ago, that's great news. But here's the other aspect of it. What is starting to happen is the fact that we started to see all of these different types of growth stories with commodities, especially oil, because of the reopening of the world. And you see that right now with China as well. But when it comes to what's actually happening right now is that we have a slowing of demand. So supply is starting to creep up, demand is starting to come down. And when we start seeing that, that really starts to show that prices start to come down. That is what we call disinflation. So it's not deflation necessarily, but it's a slowing of the growth, or sometimes just kind of a stopping of the growth of inflation, the pace of inflation. So disinflation can actually be very bad as well, especially when we couple where the economy is going. That actually signals a very, very specific type of environment for the overall economy. And what that signals, and let's go back to our lead index here, the Lion's Wealth Economic Activity and Development Stages, that we are in what's called a lead 4 stage. Now, just by way of an example here, this is just one area that we are in, but each stage has thoughts about how we are growing and what happens with the economy and the stock market and the bond market because of that. So if we're in lead 1 and lead 2, lead 1 is where we actually have a lot of growth in our economy but not a lot of inflation. That's the Goldilocks scenario. That's where we have just this really epic amount of growth that's happening, and we actually can see a lot of asset classes do very well in that environment. Well, conversely, we have lead 4, where we're at right now, and where we're projected to be for the next about 6 months is in this category. Well, that's basically the reverse opposite. We have a slowing of inflation, but we also have a slowing of the growth of our economy. This is where economies go to die, in that lead 4 kind of area there. If economies stay here long enough, this becomes really bad very quickly. So we don't want to stay here long, but we have lead 1, we have lead 4. Lead 2 is now where we have a lot of growth and some inflation that's starting to happen. That's where economies boom. So we have the Goldilocks scenario with lead 1, we have a booming of the economy in lead 2, and then we have a stagnation that happens in lead 3, where we don't have a lot of growth but hyperinflation, or a lot of inflation that has been more than what we've had historically. So just by way of talking about that, we came into last year, 2022, in that lead 3 stage where we had a lot of growth of inflation, but the growth of our economy started to slow. But being in this lead 4, we've already had 1 quarter. So we've been through here for the past about 3 to 4 months, and we're projected right now mathematically to be here for another about 6 months or so before we start turning a corner and actually starting to see some of this growth start to happen again in the economy. But what does that mean? Well, that means that we have a lot of room for kind of what we call false starts to happen. And what you're seeing here is going back to 2000 to 2002. And this was specifically what you're seeing here, done by Hedgeye Wealth Management, is a chart that really is showing a lot of information about where the stock market was, and specifically the NASDAQ, so a lot of those growth type companies. And what you are starting to see here is that there's a lot of room that we had for the price to fall, but also we had some huge kind of upturns in the stock market over that course of time. But it took 3 years for everything to finalize with respect to the stock market and the NASDAQ here. So I wouldn't be too quick to say that we are past all of the hardships that we saw last year. Now, yes, there's a lot of people that are saying we have bottomed and we're starting to go back up, and some stocks have. Yes, absolutely. But when we take a look at overall, the bond market was really horrible place to be invested last year. And last year for 2022, it was not so much of a recession worry, it was not so much of a valuation of stock worry, but it was starting to be that as we started raising interest rates, the first things that saw kind of the crumbling of what was happening were bonds. And bonds, remember, as all of these different types of institutional accounts are there, they have to start buying more bonds by selling some of the stock market. So they have to basically right the ship about every quarter. And when that happens, you start seeing stocks start to sell off, and maybe not even because they were supposed to or needing to, is because they had to sell those to buy other areas so that they could go back to their mandates of how they were staying invested. Well, because of that, we could say since last year was a bond market type of an event last year, driven by those interest rate hikes, this year is going to be a little different. If we take a look at what this signals, it means that we may not follow this, absolutely, but this was the most closely associated time period to the environment we're in today. That's why I'm bringing this up right now. And what that also means is that we have more room for hardships to come. And this year, we're definitely thinking that it is going to be more of what we call credit event. And you've already started to see this happen. And what I mean by credit event is bankruptcies. You're really starting to see a lot of companies start to declare bankruptcies or really start to say that their basically sales are slowing significantly. And the most recent one over the weekend was Bed Bath & Beyond to declare bankruptcy. And you're going to start seeing this happen more and more with companies because as they are not able to keep up with sales, they have a lot more debt obligations that are coming on board. And you're starting to see a lot of the retailers specifically that have double and triple ordered their basically stuff from over the last 2 years because of all the supply chain issues. They are unable to sell. So what that means is they need to get all of this inventory off the book. So they're going to have drastically marked down prices. And when you do that, you don't have the margins to sustain yourself. And over time, again, going back to that lead forward type of environment, over time that could be the death or the basically the bankruptcy of that company. So there's a lot to be really worried about here with respect to what's to come. But how do we look with what's coming, what the thought process is with the stock market and the bond market and the economy, but how do we look to what we can be invested into? And when we take a look at what has been working historically in each one of those lead stages, right now in lead 4, yes, that's kind of what we call those contraction type of events. Well, there's still some companies and some stocks and bonds that work out very well in this environment. So when we take a look here, one of the areas that it shows is that utilities, consumer staples, both those are great places to be invested. Now, historically, healthcare has not been as big of a place to be invested, but what we're starting to see today is that yes, they're starting to see some really big inklings that healthcare could be a great place to be invested as well. So there's 3 ideas right there between staples, utilities, and healthcare related stocks. Now, I'm not saying go ahead and just invest all of your money into those types of events. No, this has to be something that you do your own research on, or you can give us a call. We'd be happy to set up a time to meet, talk through your portfolio and how that these basically stocks and everything relate to your portfolio as well. But outside of that, we do know that at some point in time, the Federal Reserve is going to stop raising interest rates. They've already started to signal that this will probably be the last time here in February that they're going to raise interest rates. Now, it doesn't have to be, but they're starting to signal that. And if that's the case, if they just stop raising interest rates, bonds, specifically some of the longer term bonds, could actually be a great place to be invested. So we're starting to see some inklings of bond market starting to work as well, which is great news because last year nothing worked with respect to bonds and stocks. But this year, if we start having cherry picking some of those stocks that are working, if we start to add in some of the bonds, specifically when it's time, when it's appropriate to do so, it may be a great opportunity for you to actually start to see some growth happening in certain areas. But that one area that's going to shine more than others, precious metals, and specifically when it comes to gold and other precious metals as well. So take a look at those when it comes to your own portfolio, whether it is consumer staples, healthcare, or gold. Those are going to be some of the areas that are going to help sustain through this period of time. Now, the one element that I did not talk about here are all of the growth related stocks that you have been owning for the last 10 to 15 years. Those most likely are not going to see the rebounds that you're expecting over the course of probably the next 6 months at the minimum. But when we start turning the corner and we start to see growth happening in our economy and start to see us go from lead 4 back to lead 1, that is when we know we're going to start making the shifts back into growth stocks. So there's a lot to come, but right now remember the biggest element is risk management and to get through this period of time. Because you've made it this far, I want to celebrate you. You see, most people start but don't finish. Most people want to have a better portfolio, but they don't take the work and do the work necessary to make it happen. But since you are different, you want to be working with not only growing your own portfolio, but risk managing it correctly. I would like to offer you a special one-on-one consultation so that we can be taking a look at where you're at today, where you want to go, the risks that are associated, and how we can be helping to improve your overall portfolio, as well as helping to improve your overall wealth management plan. So with that, click on the link below and sign up for our consultation, and we'll be happy to talk through this with you. Now, while you're at it, sign up and subscribe to the YouTube channel here so you can be kept up to date on more tips, tricks, and strategies for the months and years to come. Click this link right here to see more tips, tricks, and ideas for how to improve your overall wealth plan, as well as talk through your overall investment strategies. With that, I'll see you in the next video.